Hello, dear friends. My name is Nathan. Today we're going to do something most people don't do when silver jumps. We're not going to scream breakout, and we're not going to hunt for one random headline to blame. We're going to diagnose the move like professionals, using the two macro levers that most consistently push silver in the short term: the US dollar and interest rates. And I want to start with a promise that's sharp enough to be useful. In the next 20 seconds, I'm going to give you a 3-screen read: DXY, the 10-year, and silver, so you can instantly tell whether today's move is real or whether it's just a pop that's likely to fade. Here's the read. Screen 1, the dollar index DXY. Screen 2, the 10-year yield, US 10Y on many platforms and sometimes shown as TNX. Screen 3, silver, XAGU spot, and if you follow futures, COMEX SI. If DXY is easing and yields are calming, that's pressure off. If silver is jumping in a pressure-off environment and holding levels, follow-through odds go up. If DXY is snapping higher and yields are spiking, that's pressure on, and silver needs stronger proof because it's fighting the wind. That's the dashboard. 3 screens. No confusion, and we're going to build this into a simple decision tree you can use in real time, so you stop chasing candles and start trading confirmations. Before we go deeper, let me eliminate platform confusion completely, because if your viewer has to guess symbols, you lose them. Dollar index is DXY. 10-year yield is US 10Y on many platforms, and on some charting tools, it's TNX. For real rates, the clean proxy is the 10-year TIPS yield. Silver spot is XAGUSD, and futures are commonly shown as SI or COMEX SI. If you can open only 3 charts, open DXY, US 10Y, and XAGUSD. If you can open one more, open the 10Y TIPS yield. That's the whole setup. Now, let me tell you why this 3-screen approach works so reliably. Markets are not moved by stories first. They're moved by constraints and flows. The dollar and rates are upstream. They influence funding conditions, risk appetite, and the opportunity cost of holding non-yielding assets. Silver is downstream. It reacts. That's why you diagnose upstream first and then confirm downstream with price action. And if you want a quick mental model, think of it like this. The dollar is the steering wheel for global liquidity mood. Rates are the brake pedal for financial conditions. Silver is the passenger. When the steering wheel turns and the brake pedal changes, the passenger moves, sometimes violently. The passenger doesn't have to know why the wheel turned. It just gets thrown around. Your job is to watch the wheel and the brake, not argue about the passenger's emotions. One quick trust line before we go further. This is educational analysis, not financial advice. I'm not telling you what to buy or sell. I'm showing you how to read the driver behind the move so you don't get emotionally hijacked by a green candle. Now, the single biggest mistake people make when silver spikes is treating it like it must be a silver story. They look for a silver-only headline, mine issues, refinery rumors, social media narratives. Sometimes those matter. But most day-to-day spikes in silver, especially sudden jumps, are macro reactions. They are dollar reactions. They are rates reactions. They are positioning reactions. They are pressure off moves or demand on moves. If you don't start with the pressure gauges, you'll keep getting surprised by moves that were visible in the macro gauges. So today, we do this cleanly. We define pressure. We decode DXY. We decode rates and real rates with a solid proxy. We separate pressure off from demand on using measurable rules. We define key levels and the hold rule so you can confirm or invalidate the move. Then we close with a tight checklist for what to watch next, because your future decisions matter more than today's explanation. Let's start with the concept that ties everything together: pressure. Silver is sensitive to financial conditions. When financial conditions tighten, silver often struggles. When conditions ease, silver often breathes. That's not a superstition. It's the opportunity cost of holding a non-yielding asset. It's the way liquidity flows through risk assets, and it's the way positioning responds when the macro wind shifts. The 2 easiest daily pressure gauges are the dollar and rates. When the dollar strengthens, commodities priced in dollars often face headwind. When yields and real yields rise, the opportunity cost of holding metals often rises, and metals can face pressure. When the dollar softens and yields calm, pressure eases and metals often rebound. Not perfectly, not every day, but often enough that it's a framework you can rely on. Now, driver number 1, the dollar. DXY is the US dollar index. The label varies by platform, but the idea is the same: how strong the dollar is versus a basket of major currencies, and often the tone of US-centric financial conditions. Why does DXY matter for silver? There are 3 practical channels. First, Pricing mechanics. Silver is priced globally in dollars. When the dollar rises, the same ounce becomes more expensive in other currencies. That can dampen marginal demand at the edges and slow upside momentum unless something else is overpowering it. It doesn't mean demand disappears. It means the market needs more force to keep pushing up. Second, liquidity and risk tone. A rising dollar frequently shows up when markets are leaning risk off or when conditions are tightening. In that environment, leverage becomes more expensive. Risk managers tighten exposure, and commodities can face selling pressure as part of broader de-risking. Third, positioning and rebalancing. A lot of macro funds and systematic strategies trade metals as part of broader baskets: risk, inflation, growth, and liquidity regimes. When the dollar strengthens, those baskets can rebalance and reduce exposure. That's flow. It doesn't require any new silver headline at all. Now flip those channels and you get the bullish case for a dollar move. When DXY softens, pressure eases. Dollar weakness can improve the price to foreign buyers effect, can signal loosening conditions, and can trigger repositioning, especially if the dollar trade was crowded. This is why metals can jump on a day when DXY breaks lower, even if nothing silver-specific happened in the news. Here's the nuance that improves your accuracy. Markets respond to change, not just level. A dollar that has been strong for weeks and then rolls over can trigger fast repositioning. Traders who were leaning into dollar strength unwind. Some cover, some hedge, some rebalance. That can lift commodities quickly. So when silver jumps, don't just ask, is DXY high? Ask, did DXY shift direction and speed? Inflection points matter. Now, driver number 2, rates. Most people hear rates and think it's too abstract. It's not. The simplest daily proxy is the 10-year yield, US 10Y, on many platforms, sometimes shown as OTNX. It's a pressure gauge for long-term money. Why do yields matter for metals? Because metals don't yield. If yields rise, investors can earn more holding bonds or cash-like instruments, and the opportunity cost of holding non-yielding assets like gold and silver can increase. But the more important layer is not just nominal yields, it's real rates. Real rates are yields adjusted for inflation expectations. You don't need a textbook. You need a clean proxy. If you want a real rate pressure gauge, watch the 10-year TIPS yield. That's one of the cleanest pressure gauges for metals. When 10Y TIPS yields rise, real rate pressure rises, and metals often face headwind. When 10Y TIPS yields fall, pressure eases, and metals often get support. And let me make that practical. If you're sitting there thinking, I don't want to do math, good. Don't. You don't need to calculate real rates. You just need to watch the proxy. The 10Y TIPS yield is the market's read on real yield. If it's moving up hard, that's usually bad for metals. If it's rolling over and falling, that's usually supportive. Now, I want to add one line that keeps this framework honest. Silver is not gold. Silver is a hybrid metal. It has monetary characteristics and industrial characteristics. That's why silver can sometimes move against the dollar and yields if industrial demand narratives, supply constraints, or positioning flows dominate for a period. So we don't treat DXY and rates like remote controls. We treat them as powerful influences that explain a large share of day-to-day moves, and we confirm with price action. That brings us to the most useful separation: pressure off versus demand on. A lot of content says macro helped and stops there. We're going to make it measurable. Pressure off move equals DXY down plus yields or real yields down or calming. If the dollar eases and real rate pressure eases, metals often breathe. A silver jump in that environment is more likely to be a pressure off rally. Demand on or flow move equals silver strong even when DXY and yields are not supportive. In other words, silver rallies despite the macro wind not helping. That suggests silver-specific demand, supply dynamics, or positioning events are overpowering macro headwinds. This distinction matters because it changes what you watch next. If today was pressure off, follow-through depends heavily on whether macro relief persists. If today was demand on, the move can be stickier even if the macro turns slightly. Now let's put this into an if-then decision tree that actually reduces mistakes. If DXY is down and yields or 10Y TIPS, real yields are calm or down, follow-through odds rise. Pressure is off. The environment is supportive. If DXY snaps up or yields and real yields spike, the bar rises. Silver must hold levels and show strength despite headwinds, or the move is more likely to fade. If DXY and yields are mixed, one supportive, one not, then you demand more evidence from silver itself. You don't guess. You don't chase. You wait for confirmation. Now we need to define what evidence looks like without turning this into a charting class. Evidence starts with key levels. Here's the method in one sentence. A key level is the last 2 to 5 sessions high or low, or a breakout point where price is held or rejected at least twice. That's it. 1 or 2 levels. No decoration. Now define whole, because this is where people get trapped. Professionals define it with closes and structure. Here is the close-based rule. If silver closes above the breakout level and, in the next session, does not make a lower low back into the prior range, the move is being accepted. If silver closes above and then quickly breaks back down into the old range, that's rejection. Intraday spikes can be noise. Closes and follow-through are where acceptance begins. Let me give you an easy picture. Imagine silver breaks above a ceiling that has rejected price a few times. If it breaks above, closes above, and the next day dips but holds above that ceiling becomes a floor. That's acceptance. If it breaks above intraday and then closes back below, or if it closes above and then immediately dumps back below the next session, that's rejection. This one rule saves you from most fakeouts. Now let's apply this to why silver jumped today using the dashboard. If silver jumped today while DXY eased and yields or real yields eased, that fits a pressure-off diagnosis. In that case, the follow-through question is, does DXY stay soft? Do yields and real yields stay calm? And does silver hold the breakout level into the close and into the next session? If silver jumped today while DXY and yields did not help or were even mildly against it, that points more toward demand on or flow. In that case, the follow-through question is, does silver remain strong even if macro stays neutral or slightly negative? And does it hold key structure? Now I want to address why today without pretending we know one perfect headline, because credibility matters. Macro relief moves usually come from 3 buckets: economic data like inflation or jobs, shifts in central bank tone, or changes in risk sentiment. Those are the common drivers that move DXY and yields. When you see DXY and yields shift together, something in one of those buckets likely changed. The label matters less than the effect. Pressure changed. Now there's a second reason silver jumps that doesn't require any fundamental story at all: positioning. Markets move because exposure changes. If traders were positioned for a stronger dollar and higher yields and that thesis breaks, they unwind. That unwind can lift metals quickly. Sometimes what looks like new demand is just less selling plus short covering. That's why the move can feel sudden. It's not always that the world learned something new. It's that the market got positioned wrong. Here's a quick way to spot a positioning-driven jump. The move is fast. It happens in bursts. Pullbacks are shallow for a while, and you see other assets react in a similar pressure-off way. Risk assets breathe, the dollar eases, yields calm. That is the signature of macro repositioning. But if silver is ripping while the dollar is flat and yields are flat and nothing else is moving, that's when you start thinking silver-specific flow. That could be physical demand chatter, supply concerns, or just a metal-specific squeeze. Again, you don't need to guess the story, you just need to recognize the fingerprint. Let me give you a concrete example of how this read saves you in real life. Imagine silver jumps 1%, 2%, 3%, and your brain starts whispering, if I don't buy now, I'll miss it. That is exactly when most people lose discipline. So you open the dashboard, you see DXY is falling steadily and the 10-year yield is cooling. That tells you the environment is supportive. Now you don't chase blindly. You wait for structure, a pullback to the breakout zone, or a close above the level that turns resistance into support. Now flip the example. Silver jumps hard, but DXY is ripping higher and yields are spiking. That's pressure on. In that environment, the jump might still happen, but it needs extra proof. You demand a stronger close, stronger follow-through, and you size smaller because the wind is against you. If you ignore that and chase, a single macro reversal can wipe out the move in hours. The dashboard doesn't guarantee profit, but it dramatically reduces avoidable mistakes. Now, a quick mini case study concept because it helps viewers remember. In many historical risk events, the sequence is the same. Something shifts in macro expectations, DXY moves, yields move, and then metals either breathe or get crushed depending on whether pressure is easing or tightening. The point isn't to name a specific day. The point is the mechanism. Upstream moves first, downstream reacts. That's why you should always ask, what did the dollar do? What did yields do? What did real yields do? Before you decide whether the move has fuel or is running out of air. Now let's address the question viewers always ask, isn't silver manipulated? The short answer is, silver can be volatile and it can be influenced by large players, but that doesn't make it unreadable. In fact, volatility is exactly why you need a framework. When a market is quiet, you can get away with sloppy thinking. When a market is fast, sloppy thinking becomes expensive. The dashboard gives you a disciplined way to interpret, not a guarantee. And one more question. What if signals conflict? Great question. If DXY is down but yields are up, or yields are down but DXY is up, you treat it as mixed pressure. Mixed pressure means you need the tape to do more work, you demand a cleaner hold, and you reduce frequency. Mixed conditions are where most false confidence is born. So now we build the confirmation and falsification test you can use tomorrow, not just today. Confirmations. Confirmation 1. Macro stays supportive. DXY remains soft or continues easing. US 10Y remains calm or eases. 10Y tips real yields remain calm or ease. That keeps pressure off. Confirmation 2. Silver holds the breakout zone into the close. A close above the level is a sign of acceptance. Confirmation 3. Next session behavior avoids a lower low breakdown back into the prior range. If the market doesn't immediately collapse back into the old range, the move is being accepted. Now the falsification test. If DXY reverses higher aggressively and yields or real yields spike, and silver loses the breakout level and falls back into the prior range, today's move was likely a pop rather than a durable shift. Pressure returned and the market rejected higher prices. That is a clean test. No opinions, just observation. Now let's talk about the execution side, because even a perfect diagnosis doesn't help if you behave badly. 2 mistakes destroy people after a jump: chasing and forcing. Chasing is buying because you feel late. You buy the emotional price. Then the market pulls back to test, because markets always test. If you didn't plan for the test, you panic out. You become liquidity. This is how people buy highs and sell lows while telling themselves they were following momentum. Forcing is building a story around a one-day move and refusing to update. You decide the dollar is done, or rates are collapsing based on one candle, and then you trade that belief instead of trading confirmation. When macro flips back, you get trapped. Professionals don't force stories. They trade confirmations. So here's the signature line, and I want it to be your habit. Diagnose, don't guess. Trade the confirmation. Even tighter, don't chase the candle. Diagnose the driver. Trade the confirmation. Now, what do you do if you missed today's jump and you're tempted to chase? There are 2 professional responses. 1. Wait for a pullback to a key level and see if it holds. If it holds, acceptance is building and you can evaluate risk logically. 2. Participate small and add only if the market confirms. You never go bigger because you felt late. Late entries require smaller size, not bigger. Now let me give you a practical how to watch it live routine that fits the 5-minute promise but works in real time. When you open your charts, you pull up DXY, US 10Y, and ZAGUSD. If you can add one more, add the 10Y tips yield. Then you ask, what changed first? Did DXY turn first? Did yields turn first? Or did silver move first? The leader matters. If DXY and yields moved first and silver followed, that's more likely macro relief. If silver moved first and the others didn't, that's more likely metal-specific flow. Then you ask, is the move being accepted? That's the close-based rule. Is silver staying above the breakout zone, or is it leaking back below it? If it's staying above, you respect it. If it's leaking back, you downgrade it. And finally, you ask, does the environment stay supportive? If DXY starts snapping back and yields start rising, the move has to prove itself. If DXY stays soft and yields stay calm, the move has room. Now, I want to give you a simple 2-bucket interpretation of silver jumps that keeps you honest when the market is messy. Bucket 1, macro relief. DXY down, yields and real yields down, or calm, silver up. That's pressure off. The risk is that the macro can reverse. So your focus is on whether pressure stays off and whether silver holds levels. Bucket 2, silver-specific flow. Silver up even without macro support. That's demand on or positioning. The risk is that it can be crowded and can mean revert, but the upside is that it can persist even if macro goes sideways. So your focus is on whether silver keeps holding structure and whether dips get bought. Now, you may be thinking, John, but I've seen days where DXY is down and silver still drops. Yes. No framework is perfect. That's why we use confirmation and falsification. There are days where equities drag everything. There are days where a big player dumps. There are days where the market is clearing leverage. But over time, if you anchor your read to the pressure gauges and then confirm with price action, you'll be less surprised and you'll make fewer emotional decisions. Here's another common confusion. Yields were up, but silver was up too. That can happen if inflation expectations rose faster than yields, meaning real yields didn't rise. That's why the 10Y tips yield is useful. It keeps you from being fooled by nominal moves. The market can say nominal yield up, But if real yield is flat or down, metals can still get support. Now let's talk about what to watch next, because this is where viewers either become disciplined or they become reactive. Over the next session or two, the market will answer the only question that matters. Is today's move being accepted? If the move is accepted, you'll see silver hold above the breakout zone, form higher lows, and not immediately dump back into the prior range. You'll often see the macro environment stay at least neutral. DXY not ripping higher, yields not spiking hard, real yields not surging. If the move is rejected, you'll see silver give back most of the move, close back below the breakout level, and drift back into the old range. Often the macro will reverse too. DXY firms, yields rise, real yields rise. That's the rejection signature. Now, because the title says in 5 minutes, I want to give you the most compressed power paragraph summary you can use on camera or in your own thinking. To understand why silver jumped today, you don't need 10 indicators. You need 3 screens: DXY, the 10-year yield, and silver. If DXY eased and yields, especially real yields via 10Y tips, calmed, pressure came off, and silver can jump without any silver-specific headline. Follow-through depends on whether that relief persists and whether silver holds its breakout level into the close and avoids a breakdown back into the prior range. If DXY or yields reverse higher and silver loses the level, today's move was likely a reaction rather than a new regime, and you treat it accordingly. Before I let you go, I want you to do one practical thing that separates pros from panic clickers. Write your checklist down, not in your head, on paper. When silver moves, your future self becomes emotional. A written checklist lets your calm self rescue your emotional self. Your checklist can be simple. Check DXY, check US 10Y, check 10Y tips yield, check silver's close versus the breakout level, and then decide. If pressure is off and the level holds, you can consider follow-through. If pressure returns and the level fails, you step back and wait for the next clean signal. And keep your decision frequency low. You don't need to react to every tick. In fast markets, reacting too often usually means paying spreads and donating to noise. Decide your time frame in advance. Are you making 1 decision per day, 1 decision per session, or 10 decisions per hour? Most people who blow up in volatile metals aren't wrong on direction. They're wrong on frequency and size. Smaller size, clearer invalidation, and fewer decisions is how you survive the chop and participate in the real move when it finally arrives. Finally, remember this: your goal is not to predict. Your goal is to read. The market will tell you whether today's jump is being accepted. If it holds structure, you respect it. If it fails structure, you don't argue. Diagnose the driver, then trade the confirmation. Now I want you to answer 2 questions in the comments. First, when silver jumped today, did you see DXY and yields moving in the supportive direction at the same time? Or did silver move independently in your view? Second, if you could watch only one tomorrow, DXY, US 10Y, or silver's ability to hold today's breakout level, which one would you choose and why? Ladies and gentlemen, my name is John A.G. If you found this valuable, click like, subscribe, and hit the bell so you don't miss the next update. 3 screens, 3 questions. 1 rule: if the level doesn't hold, the story is dead. Subscribe. Tomorrow I'll follow up using the same dashboard. Bye-bye for now.